Phoenix Syndication Workshop 2019 is a premier educational and networking event hosted by noted real estate investors Ben Leibovich and Sam Grooms. PSW is a two-day event being held in Phoenix, Arizona on January 26th and 27th. The first day is dedicated exclusively to nuts and bolts underwriting training. Ben and Sam will give a detailed presentation of their approach, technique, and underwriting model, which allows them to pick out the best deals in this very competitive environment. A recent case study will be utilized as a basis for this training. On day 2, the attendees will learn from industry professionals. Ben and Sam will be joined by a mortgage broker, property manager, and an attorney to answer your questions. As a bonus, everyone will visit the property to experience the process in action. This type of in-depth and actionable access is truly rare and invaluable. Ben and Sam are passionate about giving back, so 20% of the gross revenue from this event will be donated to a nonprofit. Register for the Phoenix Syndication Workshop by visiting justaskbenwhy.com/Phoenix.
Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I am your host, Whitney Sewell. And today our guest is Dylan Borland. Thanks for being on the show, Dylan.
Hey, everybody. Thanks for having me. Thanks for having me, Whitney. I'm excited to join your show and see what we can do.
So Dylan is the CEO, chairman at Borland Capital Partners. His specialties include real estate investing, wealth preservation, coaching, and speaking. Dylan, why don't you give the listeners a little more about your background and how you got into real estate?
Sure. Well, I'll try to give you the 90-second window there, right? It's a long story, but in essence, Whitney, I started with flipping cars, right, when I was really young. And I had thought to myself, cars was great, but at that time in life, had a very specific income goal that I wanted to achieve. And I found out very quickly I wasn't going to do that by flipping cars. And so I picked up a book. I think I was probably 17. We won't name names because it's a political book. That's one of the top guys in the real estate at the time. And found out about this fascinating world of real estate investing and decided to go into investing in real estate. I bought my first house. I was actually at 17. I'd had my girlfriend buy it at the time because I wasn't old enough legally. And we flipped that property and made a nice paycheck for somebody that age and never looked back. So, I guess I've always had the flipping blood in my bones. Most of those people who know me understand that I started and kind of got my feet grounded in the flipping side of things. I flipped about 100 properties a year in the residential business for about a decade, and then moved into and graduated, as we all like to call it, into the commercial business. And so that's kind of how I started. So I've been at it officially in business since 2006, and depending on what year it is, we can do the math.
Awesome. That was very creative though. Even at 17, you knew you wanted to do some real estate or get into real estate, and you weren't old enough. So you found a way to make it happen. That's impressive.
That's right. Yes.
So, what was did you have pushback maybe from family and friends at that time? Like, what are you thinking buying real estate? I mean, why are you doing that? Did you get questions like that?
That's a good question. One thing that people also know about me is I'm a very humble person. I like to live under the radar. And I think even when it comes to my family, they very rarely have any idea of what it is I'm doing, even to this day. So I'm not one of those that has to talk about what I'm doing. You'll find even as I do these podcasts or interviews, I don't like to talk a lot about myself. So I, at that time, they actually didn't have any idea what I was up to. They know Dylan's always up to something. But no, I didn't get any pushback because I really never talk about it. I just do it. And, oh, by the way, you bought that building. Fantastic. Like, people might find out about it a year down the road, so.
Wow.
Yeah, I don't have that sense of having to say what it is that I'm doing. I've always been that way.
So when did you buy your first or say apartment building or, move from the single family or flipping to buying a larger building?
Yeah, good question. So I want to say Oh gosh, the years, you start to forget about the years at some point, but I want to say it was maybe 2013. I started with two apartment buildings. I had a partner who kind of was always pushing me to get into the multifamily space in particular, to step up from the residential, single family. And we bought our first two apartments, I want to say it was year 2013. One was in Minnesota and one was in Florida. We bought both of those buildings primarily first as a syndication. I'm sorry, we didn't syndicate, as a reposition. And we did very, very well. We ended up selling one of those without having to reposition the asset at all, which was fantastic. We bought it at such an attractive cap rate. Somebody approached us right out of the gate. We bought it from us. And then the other one we took through the repositioning process. And then Whitney, I kind of sunk back into my comfort level, and that was residential after that. I never really thought about, the multifamily space after that. And it wasn't until I met another partner in business about 2015 that he kind of pushed me to get back off the residential into the multifamily space. So, and since then we've been building our portfolio now the last 3 years. So.
Nice. So just to clarify for the listener who's not as familiar with this business yet, when you say reposition, what do you mean?
Yeah. So for a while, my focus was always on finding assets that needed value add, right? So value add opportunities. So we go out and find an apartment building that was underperforming. A lot of people think when we talk about underperforming, it's, the physical characteristics of the building, right? It might need some renovation work, some updating, that type of stuff. But a lot of the buildings we purchase are really just poor management, right? And so sometimes you have a great building and the management is really poor. And so you can come in and you can improve things like not just the physical condition of the property, but the operating, get the expenses down, get the income up, drive the rents up, drive the occupancy up, that type of stuff. So repositioning it, getting it to where it should be performing.
Great. So, let's talk about, some of those deals, or maybe one specifically where you learned a lot. Was it the first deal or two, or is it some recent deals possibly, where it's really helped you just build your business and just learn to grow this business or scale it in a big way? Can you tell us maybe about a specific deal that, that's helped you in that way?
Sure. I think Whitney, you learn from every deal, no matter how many you do,
Mm-hmm.
right? I mean, you could do 100 deals and you're still learning lessons. So all the way from the very first deal, even now we're in the middle of raising equity on a $72 million acquisition, right? So it's $42 million in equity. God, are we learning a lot during this process, and it's been a couple of years now. You think you had it figured out and your structure and all that type of stuff. But, I think every deal, like I'm one of those guys where it's like I do a deal and then I try to do a bigger deal and a bigger deal and a bigger deal, right? I don't try to just I do it for the fun of doing the deal. So, in that learning process, I really love learning it. So for me, I think the bigger and the larger deals you do, you start to deal with a different type of individual, a different type of investor too, right? And so, there's just so much to learn. I don't know. I'd have to pick one deal and I could probably talk about, what we learned in that and what we didn't learn. I think there's so much conversation you could have. It depends on, are you trying to raise 4 million in equity or 40 million in equity? There's so many variables that you pick one.
Help us maybe with like the first syndication that you did.
Sure. So I would say the first syndication that we did, it was two at the same time. One I bought for myself, and then one we actually syndicated. So we're doing two deals at the same time. I think the thing that, a couple lessons that we learned there, and I wrote this down prior to the show as well. One of the main lessons we learned on that particular syndication was not to wait to get the money. So we waited until the very end to then say, hey, everybody, we need your money. And on one of those particular properties, we had 500,000. It was a $1.7 million syndication. So it was $1.7 million equity raise. We had 500,000 back out a couple weeks before we were supposed to close. So that was a lesson that I learned. When you put the deal out there and somebody says, yes, I'm interested, it's, hey, great, I need the check back as soon as possible. Now we tell people, we're going to send you over the documents if you like it and it makes sense. We want to get the capital back within the week, by the end of the week. So I think that's a big lesson that we learned.
So make sure and raise enough or more than enough, right? And make sure and start raising right away. So, my next question was going to be how you've eliminated that problem or how you've improved it going forward. And sounds like you've done that by giving them, what would you say, a week?
Yeah, we give them a week. Yeah. So we set the expectations there. A lot of it comes from the expectations you set up front, right? And so now when we send a pitch deck out, for example, or an offering on the opportunity, we'll actually put those expectations right in there. Hey, this is how we're going to move through the phases of this syndication. And then part of that expectation is if you like it, we're going to ask you for your capital within a week's time frame, right? And so kind of setting that from the documents and the communication right out of the gate. I'm a big believer in, setting the expectations up front makes your job a lot easier in the end. You can say, remember when I sent you those original documents, we talked about we're going to need your capital within a week, right? For you to participate in this deal. So, that's one of the things. And then we also use, to make investors, and you guys probably use this, we use an escrow agreement. And so really we'll have them place it in a third-party escrow and contingent on, obviously, us closing on the deal. Because one of the questions is, what if you guys don't close on the deal? Am I going to be short any money, or how does my money come back? And so part of those documents is an escrow agreement with a third-party company where they're going to hold those funds in escrow until we actually close, so that they can feel safe. It's with a completely different party. We haven't had the relationship with the individual in the past. A lot of people feel comfortable with that.
So I haven't had anyone talk about that on the show before,
Yeah.
about the third party and the escrow agreement. And tell me, what does that do for the investor, and why do you use that? Go into a little more detail.
Yeah, I think at the end of the day, I think it just makes them feel more comfortable. If you have not developed a relationship with them, this is your first time, investing together. It kind of takes that, instead of them sending you the money directly and you holding on to it and saying, yeah, if everything doesn't work out, I promise I'll give you your money back, right? It kind of takes that out of it. And so you're leaving it entirely in a third party's hands. And I know every state's different in terms of their escrow agents. I think some states probably use attorneys. Here in Michigan, we just use a title company. And so we'll have our title company prepare that document that basically says, hey, they're governed by a set of laws and rules, and they're insured as well too, right? And hey, you guys will hold the money over here. That way we have it collected. We don't have to go back and get it. It doesn't disappear. Another deal comes up, which happens, and they have to put the money into another deal. Things happen all the time. That way we feel secured on our end that it's there, that money's already done, because in this business, until that check clears, you're still raising capital, right? And it makes them feel comfortable that, it's being held completely with a third party based on a set of rules and responsibilities that third party has. So, it's a great blend of the two.
So, tell us a little bit of how you fixed the problem of you had the $1.7 million raise, people backed out, and not the problem. You already talked about, you give people a week now, you set those expectations, but What did you do right then? Obviously that's a pretty high stress time, right? You had what'd you say, $500,000 backed out just before closing. What did you do?
Yeah, that's a good question. Well, I guess let me take a step back. So it might be a little bit different from our perspective. One of my investing philosophies is I will never go under contract on a property that I'm not prepared to close on 100% myself, right? So that's first. That's number one. I think as a syndicator, and a lot of lenders I don't get into the lending side of stuff, but I think a lot of lenders will require you to have a certain amount of capital in the deal. Any deal I go into, I'm said to myself, whether an investor comes in or not, I'm going to prepare to fund 100% myself, right? So that was a scenario in which I wasn't necessarily too freaking out because we were prepared to cover that gap if we needed to. But we happen to have a friend of a friend that we have done business with in the past, who I was kind of telling, we had lunch together, and I was kind of telling him, hey man, this is kind of a bummer. We had $500,000 back out, a couple of weeks prior to closing. And he just made a recommendation for another one of his friends who came in and made up the difference. So it wasn't like, I had to gotta go crazy and scrabble for capital at the end of the game, because had that person not come in anyways, I would have made up the gap myself. So I think it's a little bit unique scenario in that sense. But I think it comes with, an idea came to mind as I was talking about that, Whitney. So much of equity raising starts way in advance to your actual capital raise. I think a lot of people get involved in the syndication process and they don't have relationships already built. And so then they try to build relationships in a 30 or 40-day window, and that's a very difficult thing to do when you're asking somebody for $50,000, $100,000, $500,000 in capital, and you don't have those relationships. So I think a very critical part of the syndication process is, if you guys think you want to be in this business, you want to start syndicating deals, start building those relationships way ahead of time, 6 months, 12 months. Start having those conversations, start finding out, from people, what is it that you're looking to invest in? How can I serve you, right? And that goes into, the number one thing that I wrote down here in terms of, I think, comes to our success when it comes to syndication is, it's how can I serve you? It's not about me. I'm not thinking about what type of fee I get. I'm not thinking about what I benefit from this. It's having conversations with people every single day that's, hey, you've got some excess capital that's sitting around. What types of deals do you like? What types of returns do you like? And how can I serve you? And if an opportunity comes up that fits that, I'd love to reach out to you and see if it makes sense, right? And so building those relationships way in advance, because and a lot of people know, when you're doing your first syndication, you're trying to build those on the spot, and you pull teeth and you struggle here and you struggle there, and is it going to get done, right, in that time frame? So, my advice to people is start building those relationships way, way in advance, and that's something that I learned from the residential side, because on the residential side, the single family fix and flip, we would wholesale some deals, right? So we'd fix properties and we'd wholesale deals as well. And we'd work off of a cash buyers list. And so the larger your cash buyers list, the better chance you have of moving those deals very quickly. And so we just applied that to our syndication process. And I knew very early on, hey guys, if we're going to get involved in the syndication process, we need to start building a cash buyers list per se, or an investors list of investors way in advance of actually doing a deal. Because the last thing we want to do is, when we get into a deal, be struggling where we're going to get the capital from, right? So, sorry, we got off on a tangent there.
No, it's good. It's good information. I appreciate it a lot. So, what's been maybe the hardest part of the syndication business for you?
That's a good question. I wouldn't say anything's been hard, because I like to have a lot of fun with different things. I don't get too stressed out about too much. So I look at it as just fun, but I think there's a couple things that people can do to make the process easier, right? Like we talked about, focusing on those relationships. I think the most challenging thing when we go into a syndication is structuring the deal correctly out of the gate, right? And that's something that, when I was doing the fix and flip business, whenever we put a deal out there, I would always tell people, you get your best shot is that first shot out of the gate, right? When you list the property, your best time to sell that property is your very first week of listing the property. And I think when it comes to syndicating, the challenge that we have is figuring out what that deal structure is going to be that's most attractive to the vast amount of people out of the gate. And there's so many variables that go into that. What type of asset is it? Is it a long-term play? Is it a 5-year play, a 10-year play, a 20-year play? Is it a hospitality asset? Is it a multifamily asset? Is it a senior living asset? And then figuring out, because all of those investors in those different categories have different tastes. They have different preferred returns they want. They have different structures they want, syndication fees, management fees. So I think really sitting down ahead of time and structuring the deal right out of the gate. And we struggle with that for our first few deals, and it cost us. It cost us a lot of opportunities, because you get all geared up and you push it out there, and you find out it's a crappy structure out of the gate. Now you lose those guys. We can't go back to those guys. So I think the biggest thing that we still struggle with today, because I don't know if it's a science per se, investors' appetite is changing all the time, right? So it's structuring that deal correctly from the very beginning, and then sticking with that. And sometimes you have to, it's like a rocket ship on its way to the moon, right? Course correct 1,000 different times before it gets there. But the more you course correct that syndication, now you start getting away from a successful syndication. You don't want to correct it too many times during your syndication and find out that has the opposite effect. It looks really bad. So one or two course corrections is fine, but really focusing and spending that time and that forethought on how does this thing look right out of the gate.
I want to tell you about an upcoming real estate investing conference hosted by my good friend, Joe Fairless. Every February, Joe brings his best ever conference to Denver, which brings together the top high-level experienced real estate speakers and sponsors that has proven to be the best ever networking, content, and strategies to help grow your portfolio. The earlier you buy, the more you save. Ticket prices increase weekly, so you want to buy today. I attended in 2018, and I can guarantee you do not want to miss this conference. February 22nd and 23rd, 2019 in Denver. Go to besteverconference.com to reserve your seat today. That's besteverconference.com and use hashtag Whitney to save 10%. That's hashtag Whitney. So how, with the experience that you have now, looking back to that first syndication, how would you have structured it differently?
We would have raised more capital on the first syndication. We found out we were in a situation where we were underfunded. And so you had said it earlier in the show, raise more capital for two different reasons. The first reason is, if our plan is to raise $2 million in equity, a portion of that, always plan a portion of that is going to fall out before your actual close. So now we tell our team, hey, if our raise is $2 million, for example, raise 4. We just double it, raise 4, because prior to close, there's going to be certain people that just back out or something comes up, right? And then we raise more capital than we actually need for the actual syndication. So if we're planning $1 million in renovations and closing costs and syndication fees and all that stuff, we might raise $1.2 million or $1.3 million, because I'd rather be in a position to give money back, I don't need it, than come back and ask for more money.
So, moving forward, or before we have to go, just a couple final questions. And,
sure.
What's some of the best advice you can give to someone that's just getting into the syndication business specifically? Maybe they've had a few rentals, probably not a big flipping business, but maybe they've had a few rentals and they see, okay, we want to scale this business, do larger properties. What advice do you have for them?
That's a good question. So I wrote down prior to this, maybe 4 bullet points. I'll go through them very quick, if you don't mind.
Please.
I think the best advice, we just kind of touched on one, would be, plan your relationships in advance, because they take time. This is a line item here. It's a relationship business, and it takes time to build those deep, meaningful relationships, right? Number one on this, we talked about, being focused on providing value, unconditional value to the individual. And so we spent a lot of time ahead of time reaching out to investors. Hey, if you're interested in investing in syndications, educating people on what a syndication is, the process is, and really listening to what is it that you're looking for. And then keeping that in mind and saying, hey, we have an opportunity that's come up that fits you, right? And so being focused on providing unconditional value to the investor. We don't think about ourselves at all. In fact, I kind of just think of myself as like, I'm just here to serve the investors. That's it at the end of the day. Now, will we get something in return? Absolutely. But I don't think about that at all, right? So I think really focusing 100% on that individual, in the value that you can provide to them above yourself. Number 2, structure the deal right out of the gate, based on your investors. So you're kind of keeping in your mind, what investors are you accumulating? What relationships are you building? And would this deal suit them? And it actually, for us, works out a lot better, because now I just think to myself, hey, if we want to go out and do another syndication, I just think of the investors first, and then I go out and find a deal or attract to me a deal that fits that group of investors. And then it makes the sale easy, because I just bring them the deal and say, hey, here's the deal you guys all said that you wanted. Right? And then I bring it to them. So number 3, we always start, this is a big one I don't think we touched on, maybe we did. Start with a conservative pro forma out of the gate. So a lot of people will go out and take a deal and try to make it look just super, super attractive, to their investors, and maybe kind of fluff some things. I think people do that in this business, or maybe they're not even aware of it. They try to make this deal look just like, we've had opportunities where, investors are earning 20% or above on their cash, and we have to scale back and say to them, no, we want to keep you within what you told us your earnings are, because they think it's too good to be true, right? So paying attention to those types of things, and I can expand on that in a moment, but we're very conservative. We have a philosophy when we do our pro formas. If, we'd rather undersell and over deliver. And so our investors begin to see, if we can show them the worst case scenario, if this asset goes to the worst case scenario and sell them on that, and they say, hey guys, I'm in on that. And then when it comes to actually time to perform and it's way above what we ever sold them, that echoes a lot. And so, a lot of people, I think, are not very conservative on their pro formas because it's hard to sell a very conservative pro forma. It's much easier when you get the numbers fluffed up very high. For us, we have the opposite approach. We want to take and strip down a deal to its bare, ugly bones. What happens if shit hits the fan, and sell that. And if you're in on that, fantastic. Everything else is going to be great from there. So then we already talked about number 4 being a relationship business. Keeping in touch with your investors on a regular basis. And then I can't read my own writing here. I do that sometimes. Right. Let's see what it says. Don't be afraid to reach out to your, doesn't matter. I can't read.
Tell us some ways you stay in touch with your investors. Give us some pointers on, just building those relationships and staying in touch.
Yeah, a couple ways. So, I break it down quarterly. So I take my list of I'm always separating my list between VIPs and, people I need to really spend a lot of time with. And so the VIPs, like every quarter, I'll take my list and I have it on Google Calendar, follow up with VIP list or follow up with a regular syndication list or whatever it is that we're following up with. And I break it down. Let's say there's 1,000 people on there. And so I'll take 1,000 people, divide it by how many days in the quarter and contact that many people a quarter, right? So it could be 3 or 4 people every day. Just touch base with, hey, how are things going? Do you have any opportunities? Checking in with them, telling them what we're doing, just having a general conversation with them, And then my actual VIPs, every quarter, I'll send them something or I'll actually go and see them. So I like to travel a lot. And so if I'm in a state, I'll just reach out to them. If I'm in California or Florida or Texas, I'll reach out to those VIPs and I'll say, hey guys, I'm going to be in town. Would you mind just grabbing a lunch, right? But the rest of the list, 95% of the list, it's just a phone call. I like to get on the phone. I don't send them an email. I like to get on the phone and just touch base with them and just have a conversation. I don't really have a plan going into it other than just, hey, how's it going? Just having a conversation with them. But the VIPs, I do make it a point to see them no matter where they're at, whenever possible. So I'm always kind of thinking ahead. If I'm in this area and they're out of state or they're out of the country, if I'm there, I'm reaching out to them and meeting with them or having lunch with them,
What constitutes a VIP versus somebody you're just going to try to call?
So I would say the VIPs for me are the guys that I've established a long-term relationship with already. They've probably already invested in several deals in the past. And those are the guys that I know I can go back to for at least another 3 or 4 deals, on the spot, right? The other lists are people probably I've only maybe done 1 deal with or haven't done any deals with yet. The VIPs are the guys who get the first shot at the opportunity. So when the syndication comes up, they've got the first. I'm reaching out to them first on the syndication and saying, hey, here's our syndication. You guys want to place capital? And over time, it starts to be, you don't actually have to dip into the other list because at some point you get such a consistent base of those VIP guys that are always filling your capital spots. But those are guys that we've done deals with, several deals with in the past. And we know I don't even have to think about if I call them, they're going to place capital. Say, Dylan, I'll put 100,000 in every one of your deals or 500,000 in every one of your deals. You don't have to think about it.
Nice. So you said you track this, say in Google somehow, or how do you track, these contacts and, what maybe your conversations or ways that you can serve them?
Yeah. It's, I'm looking for a better way to do it because I was always a pen and paper guy. So I would have my vanilla folders, which I would carry around with me all around town. The last probably 12 months, I've gotten away from that. I track them through Google Contacts now, which is not the most, tech friendly way to do it, I guess. If you guys have used Google Contacts, it's very limited on what you can and can't do, but I just keep very detailed notes in there. I separate the categories. I'll make my own categories, and then I'll keep detailed notes on the contacts. So the date and time we talked, what we talked about last, what they like in terms of investments, their minimum investments, their minimum preferred returns, the categories they like to invest in, right? And that's all. But I am looking for, I guess, a better way to manage those contacts virtually.
That's great. It's a good list of things right there just to think about when we're talking to potential investors and things we should be asking them so we know when we have a future deal. And what's number one thing that you would say has contributed to your success?
I think listening to what the other person wants. At the end of the day, we're here to, I think, serve people. And taking your own agenda out of the equation. And for me, I just have this unwavering desire to provide value to people in some fashion, and I think it's very genuine, and I think that people see that and they pick up on that. And just being really focused on the other person and what their needs are. As a lead comes in or an opportunity comes in, I'm asking them, what deals have you done in the past? What deals do you like? What types of minimum preferreds do you want? What's your normal period? Is it like 2 years? You want to be very short term? Do you want to be 5 years? Do you want to be 10 years? Really listening to people and then presenting them with opportunities that are in line with what they want. I mean, a lot of people try to just throw things down people's throats that they don't want or have said to you, I'm not interested in that. And that looks bad, So being very just focused on the other person.
Awesome. So, Dylan, anything else you'd like to tell the listeners that are maybe getting started in this business before we have to end?
I think just have fun with it. You get stressed, I think, very easily, but remember at the end of the day, what does Eckhart Tolle say? Life is not as serious as the mind makes it out to believe. So I think just have fun with what it is that you're doing. Enjoy it and surrender to the process, and you're going to be okay. And on that note, a good deal funds itself. And so know your numbers. If you have a deal that's crappy deal and crappy numbers and you don't know how to evaluate it properly, you're going to have a very difficult time, if at all, getting it funded. I think if you're out there structuring good deals, so educate yourself on what a good deal is, what is a good deal, and learn how to do your numbers properly, because then the process of raising capital is exponentially easier when you have a good deal. Good deal funds itself.
Well, Dylan, tell the listeners how they can learn more about you and your company and reach out to you.
Sure. So you can reach us at borlandcapital.com. Borland spelled B as in boy, O-R, and then land, L-A-N-D. I guess I was destined to be in real estate, right? With that land ending, so people tell me. And then also on Facebook. Facebook is a great way to follow me. I'm posting a lot of stuff. It runs the spectrum. It's not always just real estate. It's just random thoughts off the top of my mind a lot of times. And that's Dylan. So you can follow me on Facebook. I think it's the little @ symbol, Dylan S. Borland. So D-Y-L-A-N-S Borland. And that's a great place to follow me and see what the heck it is that we're up to. And, we're posting all kinds of stuff there. So.
Great. Well, Dylan, thank you so much for being on the show. We really appreciate your time and providing great content for the listeners. I hope all the listeners will go to the Facebook group and join, and so we can have conversations with Dylan about his business, and we can all improve our business together. And I hope you'll reach out to him. We will talk to each of you tomorrow.
Thanks, guys.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.